Well, I've said it once and I'll say it again. The bears must be absolutely livid with today's price action. I mean, so much so that the bear of all bears, the head honcho himself, after a very cryptic tweet that just said sell, has not only deleted his tweet, but his entire Twitter account. Again, this is not the first time he's done this. As we know, the market absolutely exploded to the upside on today's trading session, largely due to the FOMC announcement of a 25 basis point rate hike, but more importantly, the far more dovish than anticipated press conference that followed from Jerome Powell at 2:30. The S&P sectors are confirming the bullish nature of this move with risk on posture. The breadth charts that we continue to monitor are definitely more bullish than bearish, but there's one very subtle divergence that I want to point out to you in today's episode of the Midweek Market Update. As always, I've got some trade ideas for you towards the very end of the video, so stay tuned for that, 3 to be precise. And of course, a thumbs up on the video is a long way to support the channel. Let's get started on our SPY daily time frame chart. What do we see here from a price action, structural, and psychology perspective? Certainly a solid close on today's session. Don't get me wrong, there is a little bit of an upper wick here, but overall, if you divide today's candle range into thirds and think about where we've closed, it's definitely the upper third. We've got a nice solid green body, and the upper wick is roughly the same size as the lower wick as well. So overall, bulls in control from a structural perspective. Location is definitely more interesting though. Of course, we've closed above our prior daily double top at roughly SPY 410, which we also know to be an important weekly level that we need a higher high above to start confirming a weekly trend reversal into a weekly uptrend. We also know it as the monthly inverted head and shoulders neckline. Now, let's be completely honest here. I mean, the level is 410 and we've only closed at 410.80. It's definitely bullish, but not as bullish as it could have been. Would have been better to close, obviously at the highs of today's range. But what I want to point out from a daily trend perspective is that we certainly produced high, and now we have ourselves a higher high. It's not like we wicked underneath 410 and then closed weak at the lows of today's trading session. So overall, today's individual bar structure definitely strikes me as being more bullish than bearish, especially in the context of this overall uptrend right here and the prior double top that we were just discussing. Now, if we think about what happened earlier on in the trading week, we of course know that Monday did produce a little bit of a pullback. We gapped down, we repair the gap overhead and then pull back down into $400.75, which should be a familiar area. We talked about this as the breakout area in the Sunday weekly watch list update. Prior resistance, first turns to support on the Thursday of last week gap fill reversal, and now we've confirmed it as support once again from Monday's pullback. There was no attempt from the sellers on Tuesday morning to push prices back down underneath $400.75 to get some sort of deeper pullback on the SPY daily time frame chart. So overall, sellers continue to be weak, and we know the rest is history. We of course traveled in the upward direction. Now, if we think about Fibonacci's and come in from the breakout candle low all the way on up to the top of today's range, look at that. I mean, a thing of beauty. It's crazy how this works, right? But the 38.2, which as we know constitutes bull flag consolidation here, is perfectly aligned with $400.75, reinforcing that number for an area of super support. And as we pointed out, with the daily higher high, we can afford some sort of higher low pullback, some sort of consolidation here. As long as it's above $400.75, the bullish structure in the market remains in play. Let's take a look at our anchored VWAPs. We haven't seen these in quite some time. All of the dotted ones are from dips of 2022, and all of the dashed ones are from highs. This one, of course, came from the CPI number. This comes from the breakout candle. All I want to point out is that we're above all of them, and this pink one here represents the all-time high anchored VWAP. So remember that the quote-unquote average buyer is now seeing green in their portfolio. Therefore, they have an incentive to add to the position. You add to winners and you cut losers, right? If more people are seeing green, there's more incentive to add to positions to deploy capital and look for continued momentum in the upward direction. These no longer really have any threat of acting as resistance because clearly we are above them. Let's go ahead and clean that up. We'll put back on the 50 and 200 SMA, blue and green respectively. And I want to show you something on the hourly chart here. Notice that we could find a higher low that's even above $400.75, and the number would be $403.75 coming from prior resistance, then found it as support, resistance here, support during today's session, and notice that's exactly where the sellers failed to really push prices lower on the initial reaction to the FOMC announcement. So if the market pulls back here, we could find a higher low at $403.75 and then make a move in the upward direction, which would be even more satisfactory for the bulls on the daily time frame chart in the context of this overall trend right here. So line in the sand, $400.75, ideal picture perfect pullback, rainbows and butterflies is $403. $400.75. We'll talk about these orange lines in just a moment. Let's have a look at our market internals. If you're not familiar with this screen, top right-hand corner's got you covered with a tutorial. Notice that the volume inflows were at first negative on the Monday pullback, completely erased on the Tuesday rally. Even this morning, slightly chipping away negative, but again, on the FOMC announcement, people were deploying capital left and right, making a significant move on Tuesday and for today's close, right at that 300 million mark. Notice that the cumulative build on the volume inflows are definitely strong and positive. We're on track for a meaningful build for the week. We're at 500 million. We want to see this get up to $1 billion. Next up, for the advanced decliners, some weaknesses on Monday. Tuesday wipes it away with a strong day up in trend zone for a majority of the time. And today's session, just like the volume read, getting positive into the close there as money managers are likely deploying lots of capital. That's what this would indicate to us, right? And stocks are getting back above the prior day's close. The tick build, not going to read into today's session because, of course, it was just a flat day ahead of the FOMC announcement. But look at Tuesday's extremely strong build. I would not be skeptical of the Tuesday rally whatsoever. We have volume supporting it, we have advanced decliners supporting it, and we also have the tick cumulative supporting it as well. Let's move on over to the market profile. This is where those orange lines are going to start to make a little bit more sense. What do we see here? Certainly some concerns. This is one of the divergences that I wanted to point out to you. The value area did not shift higher with these closing prices. Notice that it's slightly lower in the profile. It would have been more bullish to be somewhere up here. And by the way, if you don't know what market profile is, top right-hand corner's got you covered with a brief tutorial. Same thing with the point of control. It's certainly, it's not like it's flat on the lows of today's session, but it certainly didn't migrate higher with price. We also have a very clear and obvious double distribution here. Separated by single prints, and that's what those orange lines represented on the SPY hourly chart. We'll go back to that in just a moment, but for now, all you need to know about double distributions is first we have distribution 1, then we have distribution 2. If we open and stay within distribution 1, obviously that's acceptance of these higher prices. This is the level that you want to see hold up as support. For the ES, it's 41.15, and of course then, if that breaks, you're going to treat this single print area as an area very similar to a gap, thin structure, right? That's going to close much closer to 40.92. 40.92 would be the single print close down here. Once again, the fact that the point of control is in the lower distribution is a slight cause for concern. The fact that the point of control is also inside of the consolidation range from here, another slight cause for concern. Ultimately, the market closed before we could put in enough volume to have that point of control rotate in the upwards direction. So not the end of the world, but definitely keeping an eye on it. Most important thing is taking away the single print structure. Back on over to our SPY hourly time frame chart so I can show you that intraday, right? There's the single prints right around in here. So if we accept above, that's as bullish as it can possibly be, looking for continued upside. If we start to break down underneath $409.10, look for this to close almost like a gap. Ideal reversal is here, but as we pointed out, rainbows and butterflies, and then line in the sand, respectively, at $400.75. Let's have a look at some sectors now on the daily time frame chart. First of all, weekly performance. We are seeing outperformance in the risk-on sectors. XLK is at the top of the list. Oops, let's actually organize this by weekly performance. There we go. XLY is at the top of the list, which is still a very, it's a heavier weight risk-on sector. XLK is the heaviest weight risk-on sector, up 2.98%. XLY, by the way, was 3.23%. And at the bottom of the barrel, we're seeing the risk-off sectors, energy, utilities, and the XLV, which once again, I hope we cleared up any confusion there. It's a heavyweight sector, but it is technically risk off from a fundamental positioning perspective. Anyways, let's check in on the structure of the charts and continue to just evaluate the trends. XLY getting more acceptance over the top of this range here, completely bullish. Any higher lows, I mean, this one could even afford a higher low above this gap here. Wouldn't be great to fall back down into this original balance range, but I mean, this is starting to get, I don't want to say overextended because we saw the SPY weekly expected move and we were actually within it. So it's not technically overextended here, but it's been very aggressive bullish, obviously, over the past couple of weeks. I wouldn't be surprised to see a pullback. Ideally stays above 148, but line in the sand, 141.75. This is bullish for our market. Next up is the XLK. It's going to be very similar here, with a close right up at this prior high, but more importantly, over the prior double top from here and outside of this balance area. So again, big steps in the right direction for more of a risk-on look for our market. Higher low pullbacks want to stay above 135 at this point in time. So if we do pull back, higher low, beautiful. We remain in an uptrend. If we break 139.25 and go, it would be a little bit, I don't want to say scary, but you're chasing a higher high here. Be mindful of your risk, so to speak, but the next target overhead is 146. Regardless, this is definitely more of a bullish look for our market. Speeding it up through some of the lighter weight sectors, XLB, materials really lightweight, close outside of the balance, cup and handle breakout, definitely bullish, but lightweight, so it's not going to make or break the market. XLP is a risk off sector. This is a D for defensive sector. Notice that it's perking up, but it's not breaking out over any of these prior highs. So once again, this lag in the XLP is definitely more bullish than bearish from a positioning perspective. Next up, we have the XLRE for real estate. Lighter weight sector, has much more to do with the wealth effect, obviously with the FOMC and the dovish stance from Powell. We saw rates come down. We'll see that chart on the TNX in just a moment, which should imply that real estate values are going up. So no surprises here. Overall, good for the wealth effect, good for consumer spending. XLI industrials, bull flag on like a monthly or weekly time frame chart, definitely up towards the top of the range from the bottom to the top in one fell swoop. Wouldn't be surprised for a higher low, reattempt, and then a break. The number to beat is 103, and the target overhead is 105.25. The pullback wants to hold $100.50 at this point in time. I would use this $100.50 as a line in the sand. 8% of the S&P 500, so certainly worth keeping an eye on. Next up, we've got the XLC communications, not a heavyweight risk on sector, but definitely a risk on sector, having a lot of the technology cohort in it, looking for continuation in the upward direction, honestly, just breaking out of this micro flag right here. If we do continue, 57 becomes the target, it's prior unfilled gap. But if we do just consolidate sideways, if there is a pullback, just anything that's over 54.30 is like picture perfect. Anything that's really over 52.17 is still fine A-OK as well. We really didn't see much of an aggressive pullback on that Monday session, so we could afford to break 54.30, still find a higher low somewhere in here, and then rotate higher for just trend continuation in the upward direction. 52.17 is a line in the sand for sure. Next up, XLF, what's going on in financials? Looking at an uptrend as well. Very hard to say bearish things about all of these charts. Cup and handle breakout, bull flag breakout, whatever you want to call it. We did get a little bit of an upper wick here at 37, and some of the financial stocks actually saw fake breaks of the prior high. Notice that this closed right on the prior high, so I wouldn't be overly aggressive in financials. If anything, I would look for continued sideways consolidation above 36 as bullish, build out a flag, and then maybe break into the future. If we break down underneath 36, it's not the end of the world as long as we find a higher low, ideally somewhere over 35. You really don't want to revisit 34.50 at this point in time. That would be cause for concern. So just like we talk about these things being bullish, if you start to see the contrary happen, if we form an equal low down here, obviously the risk is for a dead cat bounce, head and shoulders, and the rest is history, right? So think about the market like a game of chess. I always, draw that comparison. You're trying to stay one step ahead of whatever pattern starts to unfold. Anyways, XLV, really like the fact that we closed back above 133.50. Remember that this is a heavier weight sector. It's the second heaviest weight by market cap. Although defensive in nature by fundamentals, we do want to see it at least going sideways, if not supporting any rallies higher. So the close above 133.50 does strike me as a bullish improvement, especially negating more of that breakdown look that we had in here. So solid move out of the XLV. Doesn't look like it's going to start outperforming anytime soon, but as long as we're not breaking down aggressively, good to go for our market. XLU, D for defensive, lagging just like the XLP, going sideways here, not doing anything impressive on the FOMC day here. So to me, great, looks fantastic for more of a risk off look, turning off in the market, and we'll see that in the ratio grid momentarily. Same thing with energy, the only red name on the board here, pulling back off of this recent high, right? So the fact that we're not breaking out and getting leadership out of energy, once again, does strike me as more positive for the S&P 500. If it were to be breaking out, that would be much more of a risk-off signal. It's not the case, obviously. Next up, let's have a look at our ratio grid. If you don't know what the ratio grid is or how to build the ratio grid, top right-hand corner's got you covered with another tutorial. That's one thing we've always got you with, is tutorials on how to set these charts up. Notice the top four are the risk-on sectors, and they all look great with the exception of XLV. As we just pointed out, from a fundamental perspective, it doesn't need to be outperforming, but look at the XLK making a new high here. Looks good. XLF could see a little bit of improvement. Want to get, really stay above that 36 level we just discussed on the structural chart for this to possibly just go sideways and then start to rally in the upward direction on any breakouts of a bull flag. But look at the XLY. Dramatic improvements here from a terrible, terrible look into the end of 2022, right? It's almost like these two charts, like, don't draw this as a correlation that's always 100%, but they have been recently acting opposite, right? So the fact that this is picking up the slack from here certainly does strike me as bullish. XLC gets an honorable mention, continuing in the upward direction, and the bottom four are the risk-off sectors, noting that these always want to be deteriorating if the market is actually going to be experiencing a solid bull run, so to speak. XLP is lower, XLU is lower. Energy is actually breaking down here from from a sideways trend, and real estate, as we pointed out, it's a lightweight sector, but it's going sideways. It's not dramatically outperforming the market, so all good from a posturing perspective in the market. Let's have a look at risk on versus risk off through the lens of growth versus value. So again, with that XLY, dramatic breakout there, of course, this is going to be moving as well, especially when the XLP is moving opposite to that with a breakdown. It's going to accelerate that even more here. Continues to be a very bullish data point for our market. We're seeing an outperformance of growth, which is what we want to see to support more of a risk on bullish rally. Let's have a look at the dollar. These things are going to be a little bit finicky because of what took place with the FOMC today. Remember that we were watching for some sort of wedge pattern to actually break in the upward direction, and it started. Right? It did start here, but of course the FOMC wiped that away. On the weekend update, we said specifically, looks like it might be holding its breath for what Jerome Powell has to say. Hopefully no one got aggressive in the dollar or gold, because at first, don't get me wrong, the patterns were looking quite promising up until the FOMC, right? On the gold contract, we were looking at this as an ascending wedge or a rising wedge, started to break down, but obviously on today's session has completely reversed. Once again, this relationship is actually bullish for equities as that dollar continues to head lower. Let's have a look at the TNX, which of course is the 10-year rate, and this is where some dramatic improvements are starting to be made. Remember that we are looking at this lower high phenomenon. We're looking to break down underneath the equal lows, and we certainly closed underneath 34.31 on today's session. You can see a breakdown bar has formed here. Now it's all about getting continuation. Can we actually spend some time underneath 34.31, or are we just going to pop back above it like we've done in the past and maybe go sideways in here for quite some time? Bullish for equities would be continued breakdown in the TNX, which of course would relieve some pressure in your XLK, the tech sector, the heaviest weighted sector of them all. And this relationship should also make sense as to why the financial sector didn't necessarily outperform on today's session. Financials like higher rates. With rates coming in a little bit, it's of course going to impact some of the movement in the financial sector as a whole. Let's get on over to the Fed Watch tool. Some interesting nuances I want to point out in today's session and just briefly talk about what Jerome Powell had to say today. Here is something that's very, I don't want to say alarming, but just doesn't sit well with me personally. We have the 500 terminal rate still, but notice here the increased odds for a pause in the very next meeting, and then it actually goes away in the subsequent meeting. Now, what this would indicate to me is that the market's kind of the belief that Powell is going to do something like, today we got 25, then we'll hold for a meeting, and then we'll go 25 in the future. Now, this is slightly scary because this would imply, maybe we're going to make the same mistake as the 70s if some data comes out and persuades Powell to, change the course and, maybe start rate cutting early. We don't want to repeat the mistake of the 70s, so I would prefer to see this number go, sub 10% in the coming weeks. It's going to be something to continue to keep an eye on. Into the end of the year, we're experiencing, or at least pricing in, 2 rate cuts in November and December. Now, let's acknowledge what Jerome Powell acknowledged on today's, press conference. He said that goods deflation has began. He was really excited about that, actually. Said it numerous times, made it a point to say, hey, we're actually thrilled with what's going on with inflation and the deflation actually in goods. We're waiting to see if it's going to start impacting services next. We're very optimistic about that. He wasn't worried about the JOLTS report whatsoever that came out this morning at 10 o'clock, and even said that there's going to be no rate cut in 2023, but the market rallied. Why did it rally? Because he directly said that although the market is pricing in via Fed funds futures 2 rate cuts in the end of 2023, that doesn't align with his mission, but if the inflation data supports the idea that it's continuing to drop off way faster than expected, he would be open to the idea. And the market rallied on that because as of right now, the inflation data actually is coming in at a pace that is showing some slowdown and improvements in inflation data. So anyways, those are some of the nuances. If we go back on over to the platform, here's another interesting take that I want to share with you on today's session. If we look at our core PCE, over the Fed funds rate, this is not being reflected properly yet. The Fed funds rate, as we know, just went to 450 to 475, 475. And what this has done is for the first time, it's put it above our core PCE inflation reading, right? So typically used as a metric to say, hey, you've got to raise the Fed funds rate over the inflation rate to kill inflation. We've actually accomplished that now if you're using the PCE metric here, core PCE, excluding food and energy, of course. So that's an important change as well I wanted to bring up. Let's take a look at the business cycle in terms of the fundamentals of this market. Notice that bonds are threatening that reversal in the upward direction. You've got the double bottom. You've got the break of the neckline. That would, of course, be bullish for markets. The market equities are doing the same thing as well. You've got sort of a higher low double bottom here, ascending triangle, whatever you want to call it. We've talked about this pattern in the SPX, and we're continuing to come back down into the descending triangle of commodities, which would be disinflationary. Deflationary, disinflationary. You can correct me in the comments section with what the proper grammar is there. Let's have a look at the TLT. What's going on with like risk on versus risk off flight to safety type trades? TLT not outperforming by any stretch of the imagination. So although this is bullish and moving higher with the TNX coming in, of course, the SPX is outpacing that, which would be an indication that no, we are not experiencing a flight to safety trade. HYG, what's going on with our risk appetite? Continues to stay elevated, pushed higher on today's session. Notice, though, that the SPY did make, SPX, SPY, did make a new higher high. So a subtle divergence there. That's not the one that I want to bring up to you completely in today's video that is of concern. This would just say, hey, risk appetite's still strong, but maybe slow your ropes a little bit. Look for a little bit of a pullback into the end of the week. We know that's fine from a daily structural perspective. We just walked through that, right? Other risk appetite gauges, we have the Bitcoin futures, right? So Bitcoin is here. And what I would point out, let's just go to like a 5-minute chart. Look at the 5-minute chart. As soon as Powell came out and sort of hit us with the more dovish stance, Bitcoin rallied. So that would indicate that, yes, risk appetite is certainly out there in the market, and people are optimistic about a more risk-on environment returning to our market. Let's go through some breadth indicators, and then I'll point out that subtle divergence. So new highs, new lows. All we're pointing out here is the aggression in the new highs being made. And then if we go ahead and take a look at our SPX A200R, aggression again, continuing the break in the upward direction of that double top over the 50% mark, which is definitely more bullish than bearish. This is not overextended. We're not in contrarian view in the SPX A50R, stocks in the S&P over their 50 SMA. So no concerns about being overextended, which marries up beautifully with the narrative of the expected move on the SPY daily chart not being breached, right? So no issues from that perspective as well. Let's have a look at our RSP equal weight. And then I'll point out this divergence that we're observing. So RSP, new higher high, speaks to market breadth being far better than anticipated or expected rather, or just at face value from the non-equal weight, the weighted version of the S&P 500. And again, this just speaks to a few bad apples actually weighing down the S&P, whereas the underpinnings are probably doing much better than you might have thought at first glance. So here is the divergence that I wanted to bring up in today's episode. If you made it all the way to this point, then kudos to you. I appreciate you being here and tuning into the videos, but notice what's going on. So let me know if you made it to the Dow theory portion here. Look at what we have here. Dow transports have made a new higher high, and this is not being confirmed by the industrials. So typically the rough relationship, this is not a one-to-one. Please don't, tear me apart in the comments section. But typically you think about it like this. Industrials are the products that are produced, and the transports are what moves them to, retail stores or whatever. You could think about it like that. You need to make something, and then you need to move it to the people. So right now, the transports are saying, yeah, great, we're moving all this stuff, but industrials are saying, hey, we're actually not producing so much stuff. So you need to see a new higher high here in the DJI to confirm this relationship, and that would sort of get us out of the woods from a divergence perspective. If this makes a lower low and turns underneath these lows, big red flag for our market. That would certainly be something at least worth paying attention to. We won't fight the SPY itself, but I would start to become a little bit more skeptical if that were the case for our S&P 500. All right, so if you made it to this point, let me know down below in the comments section with something in reference to the Dow theory or transports versus industrials. I'll figure it out. All right, let's take a look at some volatility products now and move right on through the end of today's analysis. VIX made a new closing low. This is, again, very hard to say anything other than bullish. The market is comfortable with this as a bottom, comfortable with this as a pullback low, and we're continuing to float in the upward direction. Of course, it does mean we're susceptible to the flood effect, and we can see that in the VVIX continuing to remain floored here. It's not giving us any early warning indications, though. It's not perking up whatsoever, which we wouldn't expect it to do on a day like today anyhow, and we are still definitely in a strong contango if we look at the VIX futures, certainly continuing this downtrend here between the February and March contracts. Let's have a look at the QQQ. Let's round out the remainder of the broad market, go through the core list, and then I will tell you about the 3 trade ideas. First up in the QQQ, what do we see here? Very similar to the S&P. Obviously, we've closed well above the prior double top here. We've made a new weekly higher high. So from that perspective, even more bullish than the S&P. Notice that the margin of the close and that level, which was 296.50, definitely a little bit more padding here in the QQQ. And also, remembering that these orange lines represent the single prints on the market profile, if we zoom in on this, Notice that if we pull back, don't hold the top of the singles, close the singles, and then reverse, it would be respecting the top of that range as well at 296.50. So that's your rainbows and butterflies pullback. The line in the sand pullback is still here at 289.75. Let's go on over to our IWM Russell 2000 and the small caps. Again, this is a risk on indication. This speaks to risk appetite. Big break over the top of the balance here. Got the follow through on Tuesday, confirmed it on Wednesday. We are at the upper edge of the weekly expected move in the IWM and small caps. So be mindful that if a pullback is going to start to develop, watch your IWM to be the first tell for that pullback, right? So let's talk about the single print levels, and then we'll move through the core list of companies. Inverted hammers, by the way, on all of the final hourly bars across the broad market. So if we do pull back, watch for the breakdown of 193.40 to close the single prints down to 192.10, and a line in the sand for this one going forward. Any higher lows above 188.90, even 187.89. You can see that on the daily time frame chart. Anything that respects this is going to be a break, retest, higher, good structure underneath us. Definitely speaks to more bullish, improved odds. Let's move through the core list of companies now. Apple is up first on the chopping block. We are certainly starting to see that 100% retracement turn into some consolidation here. We did find a lower wick that failed from the sellers underneath the lows. I would just be mindful that earnings are tomorrow after the close, Thursday after the close here. So be cautious with Apple. I would not swing options contracts through the earnings announcement, so to speak. If we are going to play this in the bullish direction, because it, of course, is in a more solid uptrend, we are looking at this as a bull flag. A break of 146 gets interesting into 149.50, and then after that is where the larger range really develops into 157.25. Again, I would probably put this one on ice, so to speak, until after earnings. Next up is Netflix. Honestly, really impressed with what's going on here. Thought that there was going to be a more aggressive pullback on the morning session. Thought we were going to rotate through this thin structure over here. Not the case. Obviously, with the FOMC, it rallied with the remainder of the market. We've got ourselves a clean daily higher low, and we're just looking to go with it if it starts to take out 368.50. We found the pullback. Now we're looking for just trend continuation in the upward direction. 368.50 breaks. Next target overhead is 378. If it does come back down, so let's say it does offer up a daily lower high here, of course, you're looking at an descending triangle underneath 352.50, and I would once again be eyeballing the thin structure to retest the top of the gap at 333. Time will tell on Netflix, but this has been an outperformer. I would probably be more likely to go with a break of 368.50. Next up, Tesla. What's going on over here? Some consolidation, right? After a couple days of going sideways after the earnings announcement and the squeeze, so to speak, didn't really outperform aggressively on today's session. Just in relationship to the daily context, it's not like we made a huge new higher high here, but we did hold 170 on the pullback, which to me is very noteworthy. If we go to the hourly time frame chart, notice that here we just consolidate above, right here, just consolidating above. So that does strike me as being healthy, the fact that we did not jeopardize this underneath us. So as long as 170 holds, continuing to look for bullish outcomes in Tesla, obviously the next upside target comes from these prior highs at 197. Next up, we've got GOOGL. What's going on with Google? A break of the range, finally, right? We had this kind of sloppy area in here. We were stuck around the midpoint for a little while. Confirmed that as support on the pullback today at 97.50 and closed outside of the range on the upside. We do have to get through these highs, which is why this is a light gray line on your screen, or a dark gray line. It's a faint gray line. 101.25 is the number to beat, and after that, the target is 103.75. 103.75 is the overhead target. Closing back down underneath 99.50 does start to become concerning for a look above and fail. Bear in mind that earnings are after hours on Thursday. After hours on Thursday for Google, Apple, and Amazon, which we'll see in just a moment. Meta is up next. What's going on with the metaverse and Zuckerberg's Fantasyland? Again, really, really impressed with the performance here. Meta continues to be an outperformer for the S&P as a whole, breaking out of a daily bull flag. Overhead targets 157, and then after that 168. I would just look to see if we can get to 157 into the end of the week. Getting there, then a pullback, and then maybe something like that into next week. The number to hold at this point in time is 148.50. Looks random on the daily time frame chart. Here it is on the hourly, clear as day. Prior resistance, it was suppressing. When we finally get above it, and of course, FOMC sends us in the upward direction. So that's the number to hold. If we get down underneath it, of course, a lower high underneath is where you want to look for the bearish outcomes for the pullback. And the levels below to watch are 144.50, and 137.50 is a line in the sand for the pullback, right? You really don't want to go, oops, that is really distracting. You really don't want to go and do something that does this and lower high underneath. So the ideal pullback on the higher time frames, like a weekly or a monthly, would be 137.50. Next up, we've got NVIDIA. What's going on with NVDA? Bullish engulfer of this entire range right here, closing outside and to the upside. Running into resistance, though, making a new higher high once again. Becomes a little bit more difficult to buy that on the higher high. You want to see an intraday pullback and then a break of that level. Next overhead target's 225.50. Also keep in mind, Look at what NVIDIA's done over the past couple of weeks. It doesn't mean it can't go higher, but once again, when you're buying these higher highs without significant consolidation or some sort of pullback to a structural level, this becomes slightly more concerning, right? We talked about the SPY footing underneath us being fundamentally strong. This is where we start to say, okay, this is thin structure. This is thin structure underneath. We need some sort of more constructive and healthy pullback to really start trusting those moves in the upward direction. Once again, this speaks to risk reward, not the probability that it will or will not pull back. It speaks to risk reward. Anyways, Microsoft is up next, finally resolving this tricky area on the chart. Really thankful for that on today's session. Going to start leaning more bullish on Microsoft now that we've got a stronger move up above 244.50. Ideal pullbacks here hold above 247.80. Then we're looking for continuation or just continuation. The fact that this is resolving this and the fact that we have an inverted head and shoulders here with a measured move from neckline to head brings us back up to a target at 261.75. So willing to go with breakouts or continued bullish looks in Microsoft. Last but not least, the mini beast, we've got Amazon in the core list. Then I've got 3 ideas to share with you. What do we see in Amazon? Again, earnings after the close on Thursday. This is one of the big 3, so be mindful of that. Probably goes on ice, but the structure here is definitely bullish. I mean, no doubt about that. Breaking the flag range here, pullback held that for a higher low on Monday, follow through, breakout over the highs on today's session. I mean, everything about this structurally is just beautiful. Watching for continuation through the overhead gap, closes at 109.70. At this point, higher low pullbacks ideally want to hold that 103.10 level. Let's have a look through these trade ideas. First up is PFE, Pfizer. And the idea here is that if healthcare is going to sort of rotate higher in the list here of the sectors, if XLY, XLK are going to sort of, pull back tomorrow, so to speak, and the market's going to hold up, then healthcare needs to outperform. And one of the names in healthcare is, of course, Pfizer. If we take out these highs, it should be clear as day that you're looking for a little bit of a breakout here. Let's go on over to the hourly time frame chart. Zooming in, you'll notice that we've got some gap to close over 44.28. Gap closes up towards here, so that's definitely an intraday scalp, 44.59. The range isn't large. This is really cheap stock, right? It's sub 50. So, you're going to have to take many calls if you decide to take that trade, but inverted head and shoulders there. The next target is really up here around this area of resistance, 45.32, and then a gap from here as well. At least something to be considering, all right? So Pfizer looking for bullish trades over the daily pressure cooker top at 44.28. Next up, we have IBM. I know it sounds like a dinosaur compared to Apple, Amazon, all these modern tech companies, NVIDIA, right? But look at the daily pattern that's unfolding. It's been beat up. It's been forgotten about. Earnings weren't all that, well, I guess they actually were. They weren't great. We'll put it that way. Regardless, pressure cooker top here, if it does not turn into a bear flag, which I don't think it will, because let's take a look at the hourly time frame chart. Notice we take out these lows. Sellers attempt to do something here. We're saved by the FOMC, and now we have a breakout level here. So what is the number? I would want to see it over 135.87, and after that, we know we've got thin structure off to the left, is why this makes sense to be looking for bullish outcomes quicker rather than slower, sooner rather than later. Target is ultimately the gap close up at 139.39. That's IBM. Not interested if it never breaks, of course, or if it just starts to dribble lower. Take it off a watch list. Let it be a dinosaur. Next up, we've got Etsy, if I could type, Etsy, there we are. And this is a weekly pattern. This is a daily pattern. This is a beautiful pattern. Look at the pressure cooker top at 140 even. Let's just quickly go to a weekly time frame chart. You can see clear as day the new uptrend that's forming. We've got lows, higher lows, higher lows. We've got highs, higher highs, equal highs, looking for that equal high breakout for the next weekly higher high. On the daily time frame chart, again, that's a break over 140. We've got something that looks like an ascending triangle from this perspective. Over 140 certainly gets interesting. What would the upward target be? Let's scrunch this chart way up. What do we have for levels off to our left? Let's grab more time. I just don't want to lead you astray by missing something perhaps that would be obvious. So yeah, this area starts to become concerning. So 150, about a 10-point move in the upward direction is probably what you're looking for. If you're a longer time frame trader, if you're something, if you're going to swing this with a 6-month time horizon, you're of course going to want to take more than that. I would probably start thinking about, again, this is very, very aggressive. I'm not saying we go here, but if the Fed completely reverses their policy, if we get back towards easy money, right, 211 starts to become interesting from the breakdown point here where things really started to go wrong. All right. So that's what I've got for you in today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by simply giving the video a thumbs up. We will be live tomorrow morning at 8:30 to cover the pre-market prep. And as always, I wish every single one of you a green trading week.